Urgent meeting. Urgent meeting.
Do you know what time is it? Why are you still laughing out there? It's time to cheers. The pandemic is over.
It's not over, boss. Before the COVID-19 pandemic, Vietnam had strong export performance, low inflation, and steady growth. However, in the post-pandemic period, Vietnam has to face numerous challenges, such as weak demand, trade protectionism, risk in the banking and real estate sectors, and slow public investment this moment too. So what is the key challenge Vietnam has to face? Châu?
So the first key challenges that Vietnam has to face is the weak external demand and trade protectionism. So as you may know, global demand slowed down and rising trade barriers reduced Vietnam's export earning. So high openness, export occupied for 86.5% of the total GDP, amplifies the sensitivity to internal shocks and far higher than its peers, for example, Thailand and the Philippines. And for example, the US 20% tariff in the mid-2025 have lowered shipment very severely to the Vietnam largest market, which is the USA, and the IMF and the World Bank warned that the greater global demand uncertainty and risk. So the overall, you can see that Vietnam growth, due to its highly open market and due to a lot of external export, is highly vulnerable to global demand swings and protectionism. So next problem is the financial and real estate sector risk. So credit have been rising faster than many peers. It accounts for 136% of the total GDP, as you can see the red line over here. And corporate vulnerability rise with 12% of firms having ICR below 1. Yes, here the red dime. So as you may know that if ICR is below 1, so firms do not have ability to pay the debt based on their income. And non-performing loans increased to 4.8% among the highest Asian, while bank capital remains thin. And high global interest rate raise refinancing risk and potential capital outflows. So the overall here is rapid credit expansion and weak balance sheets, heightened financial fragility. So the third key challenge here is slow public investment disturbance. So public investment disturbance is consistently slow, especially in the first of the year, as you can see in the table of the year, and it starts booming at every single end of the year. So administrative barriers and legal inconsistencies hinder project rollout. The firms are pretty hesitating about this campaign because they're scared of taking too much responsibility. And slow spending weakens fiscal policy stabilizing role. While Vietnam remains overly reliant on export and FDI, public investment remains lags. So the overall, it becomes more serious post-pandemic because public investment is supposed to be the main growth driver as a cushion for the external effects when private and external demand are weak, but still it's a slow resurgence, so it's not trying to be that much efficient. So I'm wondering about the trade-off in the policy in this period, Hương.
So, by the quarter of 2022, the surge in value of the US dollar caused stagnation in the domestic production and business activities. So, the Fed kept the interest rates high, creating considerable difficulty for operating monetary policy. So, in 2024, the Vietnam dong lost about 4.8% of its value, so the SPV sold around 9.4 billion to stabilize the exchange rate. To support the market, the SPV used both T-bills and OMO tools to guarantee the liquidity for the banking system while reducing the pressure on the exchange rate by closing the gap between the Vietnam dong and US dollar in the interbank market. So, the SPV also continued to maintain its bills issuance channel to prevent Vietnam dong interest rate from falling too low in the interbank market. Conversely, selling the spot USD depletes the foreign exchange reserve and also contribute to tightening the system liquidity. So when the money supply contracts and liquidity is drained from the system, the interbank interest rate rises. So it's also narrowed the interest rate differential with global rates such as US rates and reduced the incentive for capital outflows and supporting the exchange rate stability. And this reduced the aggregate demand and slowed down in the economic growth momentum. So how about official policy, Khánh Vy?
Okay, now we move to our fiscal policy measure in Vietnam. The first one, through Decree 43, VAT reduced from 10% to 8% for selected goods in order to support the consumption. In 2023, domestic demand weakened due to the slow export growth and higher interest rates. And so we can say that lower VAT, which means the lower product prices, and stimulated the consumer spending. However, VAT reduction caused a large budget deficit. And with the impact on exchange rate and fiscal policy response, stronger domestic consumption increased the imports, which means USD can be strengthened. So people try to hold more USD. So to stabilize the exchange rate, the state bank had to, first one, tighten the monetary conditions, use foreign exchange reserves at the right time, and push the ministry to disburse 100% of public investment funds. And with the Munder and Fleming model, VAT cuts only work in the short term, because in the short run, when Vietnam don't appreciate, the interest rate rise, capital inflows increase. But in the long run, when exchange rate and capital flows return to the equilibrium and the interest rate difference declines. And now with the increase in public investment, government increased public infrastructure investment to offset declines in private investment, FDI and exports fell by more than 6.92 in 2023. And Fed also announced that they will keep the interest rate high for a long time and reduce production costs and increase the money multipliers in order to boost the GDP. And next, with the risk and long-term effects, increased risk of public debt, and when the supply of goods and labor is limited, it can create inflation. And under Munder and Fleming model, in the short term, raises capital inflows can lead to the aggregate demand will be greater than aggregate supply and cause inflation. But in the long term, when productivity improves, aggregate supply increase and long-term inflation decrease, so it will strengthen the supply chain development. So what about the global monetary tightening pressures and trade economics influence on Vietnam macroeconomic stability? In 2022, Vietnam economy faced strong pressure because the world financial condition became much tighter. Vietnam is a very open economy and depends a lot on export, so any global change affect the country quickly. A big challenge came from the impossible opportunity. Vietnam uses a managed flow exchange rate and has partly open capital flows, so it cannot fully control its own monetary policy. When the US Federal Reserve raised interest rates sharply in 2022, Vietnam had limited choices. It had to decide whether to protect the value of Vietnamese dong or accept risks like inflation and capital outflows. During this time, the VND fell by more than 10%. You can see that against the USD, because Vietnam import many input for productions, this weaker the currency make production costs higher, even though overall inflation stayed moderate thanks to the lower global prices. To tame the foreign exchange market, the State Bank of Vietnam sold about 22 billion USD of reserve and widened the USD VND trading band from -+3% to -+5%. This action had reduced the short-term pressure, but they also lowered the country reserve to around 88 billion USD, showing a clear trade-off between keeping the currency stable and keeping enough reserve for safety.
So risks by the challenge. The first is export slowdown and global headwind. First is 2022 to 2023 export growth of 10 to 11%, but in 2022 slowed significantly due to global recession and high inventories. Two, the OECD reports world trade slowdown cuts Vietnamese export by 9 and 12 percentage points. Three is about the IMF note real estate instability, financial stress, and falling export track GDP growth. Next is about the strong trade performance and high openness. In 2022, merchandise trade grew strongly, creating a USD in 11.2 billion trade surplus. Next is export reached 342.21 billion USD and import is 331.61 billion USD. Two is Vietnam is highly open. Tariff fell from 16.6% to 1.1% after WTO and FTAs. And three is about the in 2023 trade to GDP ratio reached 165%, among the highest globally. After 3 years, the IMF projects the Vietnam reserve could fall to about 2.2 months of import by 2025, highlighting the long-term cost of the State Bank of Vietnam policy responses after 2022.
To counter the continued capital outflow and pressure on the DND, SBB raised policy interest rate, increasing the discount rate from 2.5% to 4.5%, and the refinancing is from 4% to 6%. This measure helps slow capital flow and reduce the immediate exchange rate pressure. However, the tighter policy environment also brought trade-off. Higher interest rate restricted credit, raised borrowing costs, and weakened the consumption and investment, contributing to slower GDP growth in 2023. Tighter funding increased real estate and bond risk, and despite post-2022 stabilization, Vietnam policy buffer weakened.
And now the source of resilience. The first is strong FDI inflows, especially electronic and supposed recoveries and integrations in global supply chains. Next is about the OECD one highest opponents and large FDI attraction increased exposures to protection news and supply chain disruptions. Next, and the last is about the fiscal support since 2022 is about the tax cuts, VAT reductions, interest support, debt relief, helps stabilize income post-COVID. And the last is about the rising to protection risk and impact on growth. And the first is Vietnam exports to the USA might reach about 30% of GDP in 2024 and raising high dependencies reach. Next is US tariff risk and trade tensions increase the policies uncertainties. And the next is about the in 2024 export rebound but stronger import while it reduced net trade contributions. And the last is early 2025 in trade surplus tightened as imports rise with the manufacturing recoveries.
Thanks to right policies and solutions, our economy has recovered and become stable again.